Good morning, everybody. How are we doing? Welcome to the Moore and McDonald Show for the 27th of August.
Yeah, good morning. Good morning. Good to have you back, Rich. Last I saw you was in the studio, which was a couple of weeks ago. I've been with Ange last time. A couple of times I've been on, I think.
Well, the birthday girl, Luke Moore. We have to wish Angeline happy birthday, wherever she is in the world. We know she'll be watching. So happy 31st to Angeline.
Happy birthday, Angeline. Hope she's celebrating somewhere with a good bottle of fizz. Maybe not this time of day, but eventually.
Now, look, that's a particularly interesting background you've got there. Is that a fake background?
This is the delights of the IG trading floor. Not that you could tell, because I think it's marketing, or I think someone that they change everybody where they sit. So I don't know actually who sits behind me these days.
Sorry, you're insinuating that marketing aren't in at 7:30 in the morning?
I am, but guess who sat next to me? Slide across. Big PW.
There he is. Proof that Pete Ward does come into the office.
Yeah, proof that we wear the same shirt when we come in as well. Clearly no coordination over here.
And well, that's brilliant. So great. We're doing it live from the trading floor. As you see in the background, I've got my disco ball, wrong side. I've got my disco ball on as well. So we are raring to go this morning. Luke Moore.
We are indeed.
Not only am I going to Coldplay tonight, so I am in a particularly spriteful mood. I am not feeling yellow this morning. We've also got today's show. It comes to you sponsored by MongoDB, because yes, Julian Wheeler laid it up and knocked it out of the park, because MongoDB up 30% after hours after Julian Wheeler tipped them in the show yesterday.
We've got to call you Philip all day long. We have to call you Philip all day long, don't we?
Wasn't that brilliant? Absolutely brilliant. So obviously,
Phil Rich.
The background story from that being that producer Phil had been speaking to Julian on WhatsApp. So because he then thought that was me, then he was calling me Philip for the whole interview, and he did it 3 times, and I picked up on it I didn't pick up on it the first time, and then the second time I thought, oh no, he is actually he's called me Philip.
you can't correct him on air.
Yeah,
you can't correct him on air, or he'll never come back. We need him back.
We need him. He can call me whatever he likes, Luke.
I know.
Philip.
MongoDB up 30% on numbers. That's one hell of a shout. 279 it finished. 279.42 it finished in the post market last night.
Yeah, so that's a little bit rich for me. I've got an option structure on. I put it on about 3 o'clock yesterday afternoon, and we'll go through that let's do it in fast markets. We go through it in there. But What else is coming up on today's show, I hear you ask?
Let's have a little look, shall we? So I'll be here with you through till fast markets. We'll be here opening bell, 8:15 fast markets. And then at 8:35, you'll be joined by Joachim Clement for the Expert's Edge. And then after that, it'll be the opening bell. And then the Art of Investing. Are you up to 6 episodes already?
Wait, do you know what? We've done 6. And tomorrow is the 7th, and tomorrow we're doing a Q&A, and the Q&A is anything to do with portfolio construction, anything to do with all the questions that you've got around how to run a portfolio, when to take profit, when to do rotation. So we've got some really good questions in there. There's 13 of them so far, but it's not too late to get your own question in. So send it in to us, richard.mcdonald@ig.com, or pop it in the chat there and we can add it on.
Yeah, and the question can't be how much MongoDB should I buy or YOLO my portfolio into. That shouldn't be the question, no.
No, that's just your trading account.
This
is your real account, your pension, which, well, maybe some people's pension isn't bigger than their trading account, is it?
Well, no, definitely not. Speaking of pension, a lot of the stuff I've got in my pension, Scottish Mortgage, of course. I think I've told you that before. And their biggest private holding, SpaceX. Did you see them overnight?
Oh, no. There was show me. Do you have a video of it for us?
I do. So if you can, is this up on the screen? Let me just do this. Yeah. Okay, so hang on a second. Let me just make this look all pretty. So they had their super heavy rocket. Now, if you recall, this rocket it's blown up. This is the one that they're supposedly going to send us all to Mars on, and it's blown up every time. You know, they've never found a chance to land it. Last night they landed it. So what you're looking at here, if the stream works particularly well, this is it coming back into the sea, and look at the state of that. And if we're killing everybody's ears there, let me just turn that down. And look at that. And then it explodes for good measure.
It's pretty
It's quite
brave.
impressive.
Pretty brave of somebody to be sitting on a jet ski recording it.
Oh yeah, quite. Especially as well, because if you didn't pick up, it slightly missed the money shot as well. It was like ever so slightly disorientated a little bit. But I mean, that's one step closer to Mars for the gang at SpaceX.
Would you ever want to be working in that kind of environment? Look. Any aspirations to be an astronaut?
I'd have loved to have been an astronaut. That would have been so good. I had dreams of being a pilot at one point, and the problem was my eyes wasn't very good. I'm half sighted in my left eye, and so I wasn't able to. No, so I couldn't be a pilot even if I wanted to.
Right, should we go into some overnight action and see what's happening in markets then, sir?
Let's do it.
Okay, so what do we have? Let's go to the front page of the Times this morning, because there was a bit of a wipeout in UK retailers yesterday. It's like suddenly Deutsche Bank had to point out to people that the country's coffers aren't in that great a state. Taxes might have to go up, and some retailers might not benefit from that. It's amazing it takes an analyst to actually have to point that out to people.
Yeah, it's pretty dire stuff in the UK. It's difficult to get excited about what's going on in the UK at the moment, and I think that's the kind of stark difference between you look at the US, potentially not looking at Europe. You look at where do the growth levers come from? It's if it's not changing the way in which they're going to tax properties, it's changing the way in which they're going to tax, wealthy. It's just take in the moment. I'm yet to hear the exciting growth story that's going to mean that we can grow our way out of this, even though the FTSE's at an all-time high. It just seems like the difference between what I suppose the city is seeing in the stock prices and the international focus that the FTSE 100 has, and what you're seeing on, to borrow the US phrase, on Main Street. It's very, very different. You walk up and down the high streets of a lot of places in the UK, and they do not look like very great places to be at the moment.
It's awful. It's just charity shops. It's mobile phone shops. If anybody wonders why the charity shops are there, it's because they don't pay any rent. They don't pay any tax for being in that location. Mobile phone shops, cafes, obviously a nice thing, but
betting shops, vape shops.
How do betting shops still survive? It's online, guys. Come on, you don't need to go into a smoky environment with 20 televisions to go and do
it. They've actually, on the one on there's a I think it's a Paddy Power on the high street near me, and they've actually recently they've unmisted the front glass, so now you can see straight in. And it's the first time I've ever seen the inside of a betting shop, because it's just not.
Oh really?
Online betting, sure, but going in just still seems a bit foreign to me. Maybe it's a generational thing, but yeah, the first time I've seen it, and it's like the first time there's any kind of like daylight going into these places, it seems.
So this is where my career started, I must admit. When I was 4 years old, I used to get taken into the betting shop every Saturday morning by my granddad, and we would put his little accumulator on, and then we'd go home, and then we'd also have done the football pools. So our entire Saturday was watching horse racing, and if he won, then we go back into town, collect his money, and then we go and buy me a toy. And then watching the football results to see because you had to guess draws. Draws were the big thing. And then we'd play Monopoly at night. So it was my brain was being trained in let's call it risk management and probabilities from a very early age of 4 years old.
Well, there you go. And look at the man you are now, TV superstar.
Yeah, called Philip. I've changed my name.
Exactly. Yeah.
Right. So on that, we saw ABF. Of course, ABF owns Primark. Primark was down about 8%. We had, ABF was down 4%, which was 92 pence. We had Wix also cut to sell, and Kingfisher was moved down to a hold. So that's why Kingfisher was down 4% first thing in the morning. As one of you pointed out to us, was very kind to point out. And then they also downgraded Next, but does Next budge? No, of course, because Next never goes down, does it, Luke Moore?
Next is one of those behemoths. What's their dividend yield now on that stock these days? Is it one of those? Is one of those ones that's just so tightly held that it just yields so impressively? But I can't remember the last time needing to go into a Next. I know that there are other shops are getting better at this kind of this kind of high street fashion. John Lewis is doing a lot better at bringing different brands in. There are, of course, Fraser's Group, which has continued to just gobble up the high street and all the different brands I have. So I still don't necessarily understand where Next fits. But then again, it's probably not for my demographic. It's kids' clothes and for that end.
I think it's outside London. Next is a very important part of the high street. So I was living in Scotland in 2022, and I had a wedding to go to, and it's like, all right, well, I don't have a suit at my mum's house. It's all in storage in London. I need to go and buy a suit. It's the obvious place. It does the job. Perfect suit. You could wear it horse racing. You could wear it to a wedding.
I'd say John Lewis fills that gap now. John Lewis feels like the place that you would go and get those.
You don't get John Lewis in small towns, though. In cities the size of Perth, and John Lewis is very much in Edinburgh, Manchester, London. If you're talking about Doncaster and Hull and Perth and Inverness, you don't have a John Lewis. So that's where Next is. The everybody retailer.
Okay, interesting. But yeah, worth keeping an eye on those. I mean, there's actually been some news this morning in JD Sports, actually, kind of on that note. So they've come out with their earnings. Let me just get them for you here. So their Q2 sales were down 3%. But they've improved their like-for-like sales trend for Q2 in North America, and they see that their FY26 profit before tax, PBT, their profit before tax, is going to be in line with the market expectations. And interestingly, they've announced a 100 million share buyback. So whilst they've had slightly disappointing numbers, I think the market will like that share buyback and the fact that their FY26 numbers are going to be bang in line with market expectations. So we'll keep an eye on where they are, and when we start to get the opening calls, we'll have a little look at those. But a little bit of news on the high street this morning. And Fraser's made an acquisition, another one in terms of gobbling up. Now, I don't know the name of this company. They've bought a minority stake in We Do Play. Ever heard of We Do Play?
No.
No. If there's anyone in the comments that can let us know who We Do Play are.
Unless it's like
Fraser's
kids play areas.
Stake. Yeah. Let's have a look. While you're doing that, I'm just going to Google We Do Play.
Well, Andrew McKelvey, of course, is our expert in JD Sports. He's saying it's a dull trading update, but very pleased to see the 100 million buyback. We've got Steve Davies and the rest of you wishing Angeline a very happy birthday. For you, those of you joined late, it is Angeline's birthday week, a very special week for Angeline. She is 31 yet again, and we're seeing Kate Murphy. Now, I did have a chat with Kate yesterday because I did short a bit of British Aerospace and Rolls-Royce yesterday, which we'll go into more after we look at this. We Do Play.
There you go. It's up on the screen. Here you go. So here's the minority. They've taken a minority stake in. It is a looks like an experience kind of play brand. So they've got mini golf, putt social, activate fitness. It looks like the old disco floors, rumble rooms. It very much looks like laser tag. I'm going to say, without knowing too much about it, you'd expect these to be in your kind of business parks for family parties and kids parties, it looks like. So if I'm not mistaken, that'll be probably one of their first moves into experiences and away from pure fashion, perhaps. Interesting.
Certainly haven't seen that before, but yeah, I do. I love a day out of those things.
Oh yeah. Yeah. I mean, it was the old bowling alley parties of kind of yesteryear when you were a kid. They're just, it was great, wasn't it?
Shall we play a game of guess what time our social media team get into the office in the background there? Because I see some movement. Is there movement there?
We've got a few bodies are turning up.
Look at that, social media in at 7:46 in the morning. Get in. Right. We now, speaking of that, the reason I am talking about our team is because look, Moore, the marketing social has been decided, and we are going to Top Golf.
Very on topic.
So, look, as a key part of the show, I do feel like you should get an invite.
Have I not? Well, I've clearly not been invited yet. So who do I need to go and ask, or who do I need to go and impress that I need to get an invite to this?
First of all, we've got to get producer Phil an invite.
Clearly.
So, and then Dom and Cam and Terence and James and Ginger in the studio.
Got to get everybody in.
So, they are the top 5 on the list, and then you'll be right up there. Pete Ward, maybe not.
He didn't hear that. So I've got everyone near me. Little Luke's just over there. Ronnie's in front of me, and Big Pete's next to me. In fact, we've got nearly got the whole harem of us.
Can we have a quick look? Spin round.
Hang on a second. I don't know if my camera's going to work. Can we see Ronnie there through the blur?
Ronnie.
Here we go. There's Ronnie.
Morning,
Little Luke in the corner. The blur's not going to help us there.
Big Sam. Never seen on Trade Live before.
Sam's never been on Trade Live before. It's his debut. There you go. Ben, do you want to give us a smile? Ben in the corner, and then Pete propping up to the left. There you go.
There it is. That is the dream team. Welcome to the IG trading floor, everybody.
Indeed. Should we talk? Oh, hang on a second. I'm going to get told off because the camera's definitely not straight there. That's better. Is that better? Producer Phil, is that better? Yeah. Should we talk NVIDIA, AI? Should we do that after the market? Should we continue talking about UK stocks? What do you want to do? There's a few more things to go through.
Yeah, let's do that in fast markets. The preparation for the big NVIDIA numbers tonight. We've had a nice little warm up with some MongoDB. Hopefully, going to have some cash in the coffers there, because I've also got a trade on for NVIDIA tonight. But we'll go through that more in fast markets as well. What else have you got for us this morning, Luke Moore?
So a couple more companies that have reported their earnings. Hochschild Mining, I think, is probably the one to keep an eye on. The gold miner, of course. Their half-year to full-year guidance has been cut due to heavy rainfall at their Mara Rosa site. They now see that their group gold production is going to be between 291 to 319,000 ounces, and then all costs will go from 1587 to 1687. They're increasing the cost guidance. So, from 1587 to 1687, that kind of $1,600 an ounce mark, up to $1,980 to $2,000 mark. So that's a decent uptick in their cost of production. So I don't know if you got the early calls there. Can we have a look if we got an early call on Hochschild just yet?
JD Sports looking down 1%. Rio Tinto has announced a new operating model to simplify the business and unlock shareholder value. Looking up 3%. Big move there for Rios on that strategy update.
I think they've also, from what I can see, they've reaffirmed strong midterm production growth. So I think that's come alongside an upgrade on their expectations.
That's a little bit frustrating. I was waiting to buy those. Of course, Tom Price told us it's not a great time of year for iron ore, but that he knew a lot of long funds that were just waiting for the opportunity to get involved in Rios. So if they do open up 2% today, then do we think that long funds might have to come in and buy them? They won't be able to wait until October, November now. Maybe they've got to come in and start buying them now. So that could kick on. Prudential up 1% on the back of H1 results. New business profit rises to 1.26 billion, pre-tax of 1.7 billion. That was ahead of consensus.
Yep.
So the stock already up in Hong Kong.
They also raised their interim dividend by 13%. You know what, these kind of insurers, they love their dividend. So what have they got a call? Have they got an early call?
Up 1%.
Okay, fairly uninteresting.
And then Hochschild looking down 5. Will that be right?
Hochschild looking down 5. Let me just have another look at this.
Ask your buddy Sam across the desk there if Hochschild are looking down 5, because that is the Sam Peach morning email of the opening calls. Is
that where it comes from? Is that where the distribution comes from? Hochschild right. In the auction, so the auctions have just opened up here, indicating down 2 to uncross at £3. So you get the early morning calls from what brokers are looking at, and that's usually what we use on the show to suggest, this is what our friends at SureCap or Cantors will be calling the market. But then what's important is looking at the auction itself. So where for the first 10 minutes of every single day, you get an auction. Hochschild indicating £3 down 2. We've also, it looks like Intercontinental Hotels, IHG, have been tipped in the Telegraph. With the article pumping their own tires a little bit here. We've doubled our money on this hotel group, but it's still worth buying today, is what they're leading with. So they're being...
That's Tempest, isn't it?
It'll be Tempest, yeah.
Yeah, you can tell.
Yeah.
Right, now Vodafone, people. Vodafone, which I have started selling my stake. When it came up in the RNS yesterday, look, that there was an update of a large shareholder. And I thought, they've obviously found out that I'm selling.
The old TR1s come through, the McDonald
That's
position
right.
Reduction.
Gone below 3%. But it was actually an activist building a stake. So there is a feared activist investor has built a £640 million stake in Vodafone. Now we know why it's been going up. It wasn't just the buyback. It wasn't just the latest set of numbers. A very smart investor has been building 640 million stake in Vodafone, which I guess is 3% then, because that's when he had to cross to notify everybody. That is billionaire
who's the
Martin Ebner.
And that person is
a feared billionaire corporate raider.
Martin Ebner.
It's interesting, isn't it? Because I'm not sure too much of what else he can do. She's already done quite a lot to turn the company around. But yeah, this is a Switzerland's Warren Buffett, he is known as. And yeah, let's see what he is, what he's looking for there.
Interesting. Okay, nice. All right, we'll keep an eye on that one in the open. Let me just see where voters are indicating to see. Was that something that came out yesterday, or is this a post-close?
Yes,
piece?
I saw in the RNS yesterday, but let me just check if what time it came out at.
Well, they're being called up 0.5% so far in the pre-market, which is, if you keep an eye on the FTSE's being called up 0.34, 0.37, depending on which time you look at it. Call it 0.4%, 92.88. And yeah, that's bang in line with the market. So not a huge amount going on there. The other one that's worth looking at is Dalata Hotel Group. So you've obviously seen some stories from IHG. Dalata Hotel Group, they've seen modest revenue growth from 306 million euros versus 302 is the expectation. So they're a hotel group mainly focused, based in Ireland, but across Europe at the lower end of the kind of hospitality chain, I suppose. So that would suggest there's been a bit of a bounce in European hospitality, perhaps. So we'll keep an eye on those guys because they are traded in London.
Right, it's almost time for that chart of the day. So, Marco Polo, are you ready? The Welsh ace just joining us here. asking, do you sell? Do you sell what? Do you sell your Vodafone? I have started to trim mine. So when this kind of thing happens, it's always nice to take a bit of profit, isn't it? Yeah, and then human resource, very clever. Luke Moore, you're gonna like this.
Go on.
We've got a name on the YouTube. One of the viewers is the human resources manager at McDonald's.
Resources, nice.
Yeah,
nice. Took me a second there. I thought it was a play on Reese there for a second, but no, it's a play on sources. Okay, nice. Yeah, very good.
Right, if you're all ready.
Just on those Deloitte hotels, if anyone's in those, they're indicating down 7%. So clearly something in there the market not liking. Just before we do the chart of the day.
Which country is the chart of the day from? It's a USA. USA. Let's go to it. Who's going to be first?
Well, the chart came up at sunrise, looking mighty fine. A clean old breakout on the 30-minute line. Rich said it's bullish with a wink and a grin. Angeline whispered, yep, we're going in. But producer Phil with his dark Stetson hat said sure looks like a breakout, but you might not want to do that. He drew a line on the screen with a crooked old smirk. You see this wick? That's reversal work. Oh, guess the chart, don't lose your stake. Is it true love or a big heartbreak? The candles lie, the lines run deep. One wrong call and you won't sleep. Cause out in this land of bulls and thieves, even the RSI can deceive. Rich grabbed his mouth, said, I ain't no fool. Phil, you've been playing tricks since the 08 rule. Angeline laughed and clicked to buy real fast. Said, if this chart lies, I'll short your past. Producer Phil pulled up a chart from hell. Flash, crash, wick, rang a margin bell. The price dipped low, then shot up high, and all three sat there wondering why. So guess the chart and guard your soul. It's a rodeo, not a stroll. If Phil's around, you best beware. He'll redraw trend lines in thin air. But Rich and Ange, they held their ground. Their guess was true and profit bound.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Right, Luke Moore, do you have a bell on the desk there? Because we have been sadly missing it this week.
Oh, well, it's too late. We're already past the open bell. Everything's open. No, I don't. What I do have, and the only thing I can share with you, is this old thing. If you remember the Chomp chocolate bar, do you ever remember the Chomp chocolate
Oh,
bar?
absolutely.
Now, if anybody on desk bites back at a joke, if someone just gives it and doesn't take it very well, you get the chomp stick waved at you because you chomped on a joke. So I can wave the chomp stick around, but unfortunately I can't wave the bell around.
There we go. London Stock Exchange opening is today sponsored by Chump and MongoDB. So we've got Vodafone up there, 60 basis points already, 88.78. And yes, some others in the FTSE just up that kind of 50, 60 basis points. Lloyd's, Glencore, NatWest, Prudential only up 57 basis points after being up 1% on the back of numbers.
JD Sports not yet open, indicating up 5.5.
Oh, brilliant. Andrew McKelvey.
They are indicating up, 5.6% now, so they'll be in an extended auction. So we'll keep an eye on those before they come out. What else have we got? We've got Lloyd's Group at the top of the pops there, up 1% on the day, trading 83.84.
Now, Rio Tinto only up 50 basis points.
On that reshuffle.
Yeah.
Interesting. So the market was calling that a little stronger than we thought. What else did we talk about before the open? Intercontinental Hotels Group, IHG. Let's see where they are. They are bang flat, down 0.05%. How uninteresting. Delata Hotel Group, down. We thought they were going to be down 7. They're down 6, 5.88%.
Right, WH Smith also up. Andrew McKelvey is having a good morning. He'll be out to celebrate for lunch today. WH Smith up 1.4%. JD Sports looking up more than 5. So Andrew's favourites there, particularly strong this morning. BHP up 1%. And there he is. He's given a hooray on the chat. His biggest holding. Come on.
Get in. Hochschild not open yet. Now indicating down 10.7%. So let's just take another look at those numbers whilst we're waiting for that to open up. So we thought, if you want to pull my screen up there, guys, we thought they would potentially be rocky. So the headlines here is they've slashed their production forecasts from their Mara Rosa mine due to the fact that they've had to close that mine due to rains. They've had a temporary suspension of the site due to lackluster gold output. It also means that we highlighted their production costs are going to go up. They're now expected to only make 35 to 45,000 ounces of gold from that mine this year, down from their previous forecast of 94 to 104 ounces. I don't necessarily think I had that before the show, but that is a big cut there, a big cut on the production. So 10.7% is where they're indicating, not yet open. Beware, just watch out for those ones if you've got them, because they're going to open lower.
Right, other losers on the day. We've got Fresnillo down 75 basis points. Gold is down 0.5% as well. Diageo down 30 basis points. And BT small off as well. So, yeah, decent open there. Shall we have a look at Europe as well?
Yeah, you do Europe, and I'll just have a quick look at the 250 just to see if we've got anything interesting going on down there.
Okay, so of the Germans, Porsche are up 80 basis points this morning, 46.5. We've got Mercedes-Benz up 0.5%, and Volkswagen much of a muchness along with BMW. And then elsewhere, Total strong this morning, up 80 basis points. And Bayer now up at 29 euros. Some good news for them last week in that court ruling. So decent moves there. Losers in Europe, we've got Peugeot down. Excuse me, about 2.5%.
Interesting going on in the 250. So I've just flicked back into the FTSE 100 to take a little look, and Pershing Square is up 1%, which puts it as the third biggest gainer on the day. Pershing Square, of course, is Bill Ackman's investment trust that he's listed here in London. You then look at the 250 and you've got two other investment trusts, Caledonia Investment Trust and the Brunner Investment Trust, both up within the top 5 of the FTSE 250. So is there something that we've missed in the investment trust world? Because I wonder why investment trusts are looking stronger, and I don't know whether that's specific due to holdings they have, or whether they are just that we've missed some story. Where are my Scottish mortgages? They are not that interesting. Bang flat, so potentially not everything. Maybe a story to keep an eye on.
Yep. Right, commodity world. Let's have a look at commodities. What do we got? We've got red across the board. Right. Small off in oil. Like I said, down 50 basis points in both gold and silver. We've got JD Sports open.
JD Sports open. They've opened 98.72, now trading 98.84. They're up almost 5%, 4.8 to the top side. Very good for them. That 100. I think that's the 100 million buyback for me. I think that's what's coming through. What is their market capitalization? JD
Lean
Sports.
over your desk and ask Ronnie what he thinks of the buyback in JD Sports.
Ronnie, what do you think of the buyback in JD Sports?
Market is that why they're up 5%?
4.7 billion, 100 million buyback. What do you think? One word answer. He says it's the only way that they can boost that company's share price.
Ronnie has never given a one-word answer in his life.
And on the flip side, Hochschild Mining, to dampen everybody's spirits, they're now down 17%. Opened at 273, now trading 253. So if you had some market on open orders, you were able to get out, and it has come lower. But if you want to pull up, have a little look at the chart there. Hochschild Mining, HOC, please. And let's just have a look and see where they've been and where they could potentially go. Because that is jamming right back into that support level, potentially. Where is that date? That around there. Yeah, what is that? Is that, I'm trying to see on the chart here. Let's see.
I must admit, I was a mining trader for 7 years, and I've never traded Hochschild.
Well, you've got a potential support becoming resistance becoming support. So it resisted around this kind of 250 level in October. You'd argue it potentially double top there. And then it was support in the early days of June. Let me just add this and go full screen so we can have a little look. So yeah, this is just the daily here looking back. We're pulling right back into the 200-day moving average down here at 244. But this is just what I'm suggesting here. If I just draw a quick horizontal line here, this is very basic technical analysis, or they used to say back of a crisp packet maths. But you've had a double test potentially of this 240 level, 242 level. It then cleanly broke through in the spring of this year. Tested it once, tested it twice. Are we going to now see a revisit of that 243 level? I will be keeping an eye on that, but it looks like it's gone straight into a volatility auction, now down 18%.
JD Sports given up some of the gains, unfortunately, only up 2.5 now. JD Sports 96.50. Come on, get back up to that 5%. But clearly somebody thought something a little bit different in that opening auction to take them higher than has subsequently traded in the market when it's open. A little bit aggressive there, I would say.
Yeah.
Oh, it's come right back now. Somebody had a fat finger in the opening auction, do you think, there?
On JD. Wow, yeah, it's come right back. Now it's a 94.84. That is a decent sized pullback, actually. That is people getting excited and then banking profits. Now, if you zoom out for us, how
maybe it's Ronnie getting short in his demo account on the buyback.
I mean, that's a rejection of that break, isn't it? You look at that level, that 95p break ish.
God, such a good story, stolen away from us so quickly.
Well, let's just see if that chop pulls out, because it's now bouncing a bit, trying to come back above the 96p level. But yeah, that Hochschild story is going to stink out the index this morning, I think, unfortunately. Down 17%, 252, spot 2 is the indicative uncross for that one. Sector-wise, what are we seeing today? Because I'm seeing Fresnillo, I'm seeing Endeavour Mining near the bottom of the pops. not really a sector sell-off there.
Well, if we go
Fresnillo down
by
1.4.
If we go by European sectors, oil and gas is leading the way today, up 60 bips, followed by the autos and the utils. The losers on the day is the chemicals. So chemicals down 40 bips, with telco flat. Telco flat despite Vodafone being up 1.2% on that activist investor taking a stake. And then we've got healthcare and retail also up about 0.5%.
Yeah. All in all, a bit of a sum up, sum down kind of day, and I think it sums up why the FTSE is flat.
Bulletproof.
Really? Yeah, really flat. Up only up 0.4. Bulletproof.
That's decent.
You still
take that?
I mean, what are we now off the highs? We're off. Let me just take a quick look. The highs came in at 93.40. We're 92.90. I mean, it's just consolidation, right, at the top of here for the FTSE. It's nothing really to worry about, I don't think.
Now, going back to guess the chart, Park in 1977 guessed Airbnb. Producer Phil, was he spot on?
Guys?
131 the stock was trading.
Well, hang on a second. If we're not getting answers from the guys, Costco. Dell.
Wait a minute, but Hamish got that before. No, he didn't. Earnings tomorrow on Dell. So, God dear, Hamish is teaching us a lesson in charting.
Well, I'll tell you, that was the reason why I didn't guess it, is it was that run up in the kind of middle, in the spring of last year that threw me. And actually, now that you know it was Dell, there was discussions around Dell being the data center provider for AI and for everything that came through with it, and so it became a bit of an AI trade, which was unexpected, really. I don't think anybody would have necessarily picked Dell as a winner in the AI space, but they do hardware. Every computer I look at around me is a Dell computer, and they do a lot of institutional. Oh, what's the word? It's not institutional, is it? They'll have a lot of commercial contracts with business and corporate contracts. Yeah. So, I mean, I think they upgrade laptops every couple of years, don't they, these days?
It's those, the non-sexy, the ones that aren't in the headlines, the Cisco's, the Dell, and the IBM. That was those the second wave of the huge boom. After your NVIDIAs and after your AMDs and everything. IBM, Cisco, and Dell eventually all went together, didn't they?
Well, did you see IBM yesterday? There was actually news in IBM yesterday.
The AMD deal, yes.
Yeah. I've just got this on my screen here. So IBM and AMD, I was reading this in real time yesterday because I was chatting to a client about AMD, and this is buzzword central. Okay, so just be aware of all the buzzwords. So strategic partnership, next generation computing architectures, quantum centric computing. Come on, that's a powerful first sentence. Basically, it looks like IBM are going to use AMD chips to empower AMD to build out their quantum chip business and their quantum computing business, and then they're going to use that to hopefully compete with the likes of NVIDIA and actually with the likes of Google with their TPU project. So it was interesting. AMD traded a lot better on this than IBM did. IBM barely moved, which I thought was quite interesting. Okay. But a story nonetheless that there's a bit more of I heard a phrase yesterday. It was the merger of cooperation and competition, and it was called co-opetition. Used co-opetition, which you'd argue that is. It was the CEO of Coinbase used the phrase co-opetition, which I thought was quite interesting.
So we could do that, could we? Not to name any of the competitors, but that would be interesting.
Well, it was a conversation. Do you know the guy downtown, Josh Brown? He does a lot of kind of podcasts and stuff. It was his podcast. He had the reason why I was listening to it is he had Tom Lee on earlier this week.
It's a good episode, wasn't it?
Yeah, of Fundstrat. It was fantastic. Talking a lot about his Ethereum treasury play that he's got going on at the moment.
I bought some yesterday, actually.
BMNR. Yeah. Yeah.
Bitmine. Yeah.
Bitmine. Yeah, so it's moved. I mean, what price? Where are they now? I've not looked at them for a few days. Are they still around kind of $50?
$50. Yeah.
Yeah. Yeah. So he was talking. I mean, it's I guess a similar play to the strategy to the SWCs of this world, where it's a increasing the Ethereum per share valuation. So this is accretive dilution discussion. So it was just interesting to get Tom Lee's view. Tom Lee's been the biggest bull in the room and proven right most of the time. But anyway, the point is that the episode before that was Coinbase, and they were talking about, you know, how they're going to use blockchain to gobble up financial services, and they were saying that, you know, they're not necessarily going to start to acquire companies, but they're going to cooperate with these players. So maybe they try to cooperate with an Interactive Brokers or a Schwab of those sorts.
Did you hear the discussion from Josh and Mike, how badly that episode went down?
Yeah, I did. Yeah.
Like, people, you know, traditional stock investors just do not want to hear about crypto, do they?
But then the other stat that I thought that was interesting is 75% of people that were polled by whatever poll still don't have any crypto. And the point was adoption. Let's do a poll here for our listeners. So of our listeners who have, very simple, yes, no, have you got crypto? Just a very simple question, because then we can judge our audience who has taken it. They were selling it from the point of adoption. So if we still don't have 2/3 of the population in the US, or those that were polled still don't have it, then there's still a big runway for this to go. That was the point they were making.
Of course, Tom Lee's argument is, in the population, 75% don't have, but under the age of 35, then it's probably more like 50-50. And that will flip, and it's going to be, 75% of people will have it. And as that generation obviously get older and take over the majority of the wider population vote, then you'll have 75% of people who own crypto, and that's why it keeps going up.
Yeah. I'd be interested to know the stats if you own property and crypto as well, for those guys in the States. You know, if the under 35s are using this as a vehicle to grow wealth, as opposed to the kind of traditional view of owning property. And
look, he's tried to be smart. He's tried to change the question. Have you invested in crypto? No. Have you got crypto?
Yeah. Do you have it right now?
Crypto at this moment is the question.
Yeah.
I'll answer that.
While we're waiting for those in, please don't forget to drop us a like, hit that subscribe button if you haven't already. It really does help out our show. And when we're back in our new studio, I can't wait. I'm seeing it. Have you guys been in the office, or are you kind of using this as a chance to just be at home and work from home? Because I can see it. I can see it over there, and it's coming together. It is coming together.
That's not what producer Phil just said in my ear. I cannot repeat what he just said, but he was not saying that it looks like it might be nearly finished.
No, I don't think that's what he was saying. I think he was saying something else about, has Rich been in the office?
So
the answer is no.
What's producer Phil? What do we think? How about we get either a photograph to show on air, or even you going in with your mobile phone and showing the live view from the studio mid-reconstruction. Right, we're going to do a live video tour of the studio after this break. So join us in a few minutes. We'll do fast markets, we'll do a preview of NVIDIA, and then we'll go to the studio. If you give us some likes, if you give us some of those thumbs up in the chat, that would be greatly appreciated. I always feel like I'm on some TikTok live doing that. Thankfully, we did TikTok live yesterday, and we pushed MongoDB. Can't even get the name right.
MongoDB. There was a story years and years ago of a client that sent us some mangoes. An Indian client sent us these this pack of beautiful mangoes, and someone put them on the keyboard of the Bloomberg, and in the midst of a day when everyone used to be back in the dealing floor, this guy just stands up and, "Get your mangoes off my Bloomberg!" And whenever I hear mangoes now, I think of that story.
Fantastic. Good. Right. Join us after the break. We will be back in 2.5 minutes for an interview.
Let's do this. Hello, Pat Cat. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Right, welcome back. We've got some live TV going on. There he is. Producer Richard, how are you this morning?
Hello, Philip. How are you?
Right, what treat have you got for us lined up here?
So we're going to try and show you some of the studio. At the moment, it is a bit of a mess right now as we are basically stripped it all apart. We've got wires everywhere. But what we can do, we can somewhat go out here.
Dun, dun, dun,
Have you got your high-vis jacket on?
We've got it all happening. There's a little preview, but we're not going to show you all of it. But it's just a bit of a, well, it's just a busy build at the moment. We've got lots going on.
Oh, so, God, green desk's still there.
It's still there. The green desk is never going away.
Where's the carpet? That's what I want to know. Has that been binned?
My job this afternoon is to saw up the carpet and put it in the bin. So if you want,
let's say thank you to the construction guys.
On then.
Guys, just want to say thank you very much for doing our studio for us. From all the viewers at home watching you now, legends. Thank you very much.
Thank you so much, guys.
Right, can I come produce the show again, please?
Okay. Yeah, go on then, Richard. Come and produce the show.
Right. Okay, so we are going to look at a special treat Luke has got for us on from Goldman's and Zero Hedge. Luke, take us through it.
Yes. So look, today's NVIDIA results day. Let's not beat around the bush. We've got a massive event later this evening, but you'd note if for those that have been involved in the space, the last week or so has been a bit choppy, and I've been scratching my head as to why, really, and it's there's a few things that have been going on, and so Goldman's head of Delta One products, Rich Privorotsky, has come out with a comment, and this is what it is. Zero Hedge kindly shared it. So there was an MIT paper on Monday last week. Oh, we got the screen up. Yep, there was an MIT paper that came up last week saying that most AI projects are not yielding positive returns. Now, that was a paper that it was actually posted the week before in a research note, but it got unusual amounts of traction. Alongside that, Meta said that they are slowing their hiring pace. Now, Zuckerberg has been on a ridiculous hiring spree, supposedly handing out $100 million signing bonuses to try and build out their super intelligence team, and they decided that was enough. We're going to stop now. We've spent all the capex money. We stop that. Then later on in the week, ChatGPT 5 came out. So we're talking about the week before last now. And as he calls it, it was more sizzle than steak. It was completely overhyped. If you recall, Sam Altman posted a picture of the Death Star, and it was rubbish. Not rubbish, but it wasn't so much of a material leap forward. Then he came out and said that he thinks there could be an AI bubble, which certainly didn't help. And then Apple come along as well and said that these large language models that they're building don't actually think. And it's like, well, yeah, it's probabilistic word generation, based on what you ask, what it knows, and therefore it comes out with some form of output. And they said, well, it's obvious that these models don't think. So, yeah, I mean, I think you'd have to potentially not necessarily understand what was going on in the back end of how these things work. So
I've got a story about that, which we'll go into after you've finished here.
Yeah, so he's said, so this is Goldman's view. NVIDIA tonight, of course, they feel like caution is warranted as the only real visibility comes with the major players' capex intentions next January. So outside of anything to do with China and comments on those H20s or the new variant, they don't think they're actually going to get anything that's really new tonight. Goldman's. Now, it looks like it's his personal view, or at least his personal comment. I'm still crazy bullish on the technology. I'd be lying if I don't use some facet of it every day. But the idea that bigger compute equals bigger output feels like a caveman's approach. The next wave likely lies in quantum or more elegant innovations. See what AMD and IBM did just earlier yesterday. And the risk, we've built too much capacity and it may need a reset before the next innovation wave. So Goldman is pouring a little cold water on tonight, it seems.
So this is very interesting, because on Friday of last week I was sitting having a coffee and a croissant, and there were two South African gentlemen sitting next to me who turned out to be scientists, and they were having the most interesting discussion. Right now, they're not talking about this from a stock point of view at all. They don't care what the stock prices are doing. They are scientists in the AI field, and they're talking about how AI in its current form is completely unsustainable. And one of them is involved in a project which is researching symbolic AI. And he said that it's been really hard. The companies wish they could get to this point of this symbolic AI, but it's been very difficult to do so. But there is a Russian mathematician who has cracked it. And to give you an example of what symbolic AI is, imagine that when you've got a self-driving car and it learns how to drive Manchester, right? Then you take it to London and it has to relearn how to drive London, right? Because it needs all the mapping, it needs everything sorted out. Well, symbolic AI just teaches the car to drive. So it's a lot more like a human, the way that a brain works, and it's designed the exact way that a brain works and our memory works. So the result of all this was that AI becomes far more efficient. The energy use becomes far less, eating up all that energy. You don't need as big data centers, because if you think about the amount of things in our brain, right, it just stores it away, doesn't it? It stores it away for when it's needed. Well, this is exactly like that kind of example. So the data centers are not needed in the capacity that they are at the moment, and the energy usage won't be the same, because that's the bizarre thing, right? Everybody talks about sustainability, and we all try and turn our lights off at night and everything. Well, AI has just made a complete joke of that. Like, what's the point of me turning off my lamp or my light in the house when, you know, one ChatGPT request burns 10 trees or whatever?
Yeah, do you know what? Actually, on that note, there was I saw the CEO of Perplexity retweet last night. He asked someone had tweeted and asked Perplexity, how many prompts would it take to use the same amount of energy as a private flight going from A to B, but it was 100 miles worth of private flight? And they said 15,000. 15,000 prompts would use the same amount of energy to fly a private jet from A to B, 100 miles.
Let's see how many there are. How many chat GPT prompts are sent per day? What do we think? There's a poll for us.
Well, hang on. Did we get the results? The result of our Bitcoin poll, our crypto poll? So whilst we're waiting.
Oh my goodness. So 15,000 prompts is one private jet flight.
Well, that was Perplexity's answer, at least, which is impressive. So the results of the poll, whilst your ChatGPT is still trying to figure that out, have you invested in crypto? 51% of you say no, 44% of you say yes, and 3% are considering it. 3% are considering it. So slightly more 50-50 with us, but I would suppose that our audience are more of an investing and trading based audience anyway, so perhaps that skews the numbers. It's not necessarily representative of the population, but a bit more of a balanced view over here, which is good to see.
Right. So there isn't time for a prompt because we got to let Luke go back to work, but I will put this in terms of how many private jet flights are there per day of ChatGPT prompts. 166,000.
So 1 day's worth of GPT prompts is the equivalent of 166,000 private jet flights, all doing 100 miles apiece.
Correct.
That's crazy. That is crazy.
And we are being told to turn our lights off.
Yeah. Well, there was a point.
That is the, if these scientists are right, then Goldman's are also correct there, and something like NVIDIA is, you'd be looking down 75% in the stock.
Yeah, well, David Sachs was saying this, from the All In podcast, the AI czar over in the US. He was saying that the GPT models that were just released were a bit more, there was a triage layer to it. So instead of querying the entire large language model to try and find your answer, it's better at understanding the context on your question and then activating the specific part of the LLM that you need. And again, it's a bit more of like your brain, the specific part of your brain that fires off when you need a response is a better and more efficient use of energy.
Wonderful. Luke Moore, thank you very much for joining us on this beautiful day. Shall we say a final goodbye to the IG PCM team?
Well, hang on, we've got more and more people arriving now, so it's you can tell it's post open hours. There you go. I'm trying to get them in.
8:30. I'm still impressed.
We got them in now. Yeah, we're here from 7 a.m. No flies on us on the trading floor.
All the other ones watching on the train in your way into work, don't feel guilty that there's already people there at 8:30.
The amount of times that we come in as the air conditioning switching on and as the lights are switching on. Yeah, or when the lights automatically switch off because they're motion censored. So if we're all here and then the lights switch off.
Good stuff. Right, Luke, have a wonderful day. And
Thank you very much.
Best of luck. Wish me luck in my Mongo.
See you later. Good luck with Mongo. Phil.
See you after the break.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Guys, where are you going? You're not going to get better than cash returns.
Mr. Clement, how are you, sir?
I am very well, Mr. McDonald. How are you?
I am full of the joys of late summer.
Oh my God, that sounds like almost optimistic, which is really unusual for you, given that you and I were both bearish going into the summer. So what happened?
Do you know, I got away with it. That move up last week, I was hanging on the word nevertheless.
Uh-huh.
And as soon as Mr. Powell, our good friend, said nevertheless, then that was it, because he had put all the risks out, and then he went with that, and you just knew that was the spark that the market was dying for.
Yeah, absolutely. No, I mean, it's clear that the Fed will cut interest rates in September. There is still some speculation about whether it's going to be a big one, 50 basis points. I don't think so. I think at this point in time, the Fed is in a situation where if they would cut 50 basis points, it would make it clear to everyone that they've lost their independence from the government, which, let's face it, they're in the process of losing it anyway. But I think it will be much more of a gradual process over the next 12 months.
Did Trump actually come out and do almost a lap of honor yesterday? About 7:30 p.m. I got some kind of tweet saying, basically him saying that he now has control of the Fed.
Okay, I didn't see that, but to be perfectly honest, he effectively will have control of the Fed next year. We all are now focusing on the Lisa Cook story. I think it's pretty clear. And if you look at betting markets and prediction markets, the vast majority of people expect that she will remain in office for the time being.
Oh,
but
really?
It's something like a 25% chance that she will be out of office by the end of this year and 75% that she will stay in place. Okay. But let's face it, the real thing, that the real two big prizes come in, obviously April, May next year with a new Fed chair. But what people are not focusing on yet is February 2026, when all the regional Fed presidents have to be reconfirmed for another 5 years by the Fed governors. And that explains why there's such a big push to replace as many governors as possible right now.
That's right. So just to run us through it, it's he needs a majority of 4, doesn't he? Or he needs 4.
He needs 4 out of the
side.
7, yes, on his side. Yeah.
And then in February, so what would happen if he does indeed have that majority of 4 people? What happens in February?
Well, in February, all the regional Fed governors, 12 of them, I think, I'm not sure, but I think 12, will have to be reconfirmed for another 5 years. And in theory, if the Fed governors in Washington are a majority controlled by Trump, they could replace all 12 of them. That's very unlikely to happen. But definitely it kind of puts a lot of pressure on some of the regional Fed governors to kind of act a little bit more in Trump's favor throughout the rest of this year, and in order to kind of avoid some of the pressure in February. And long story short, then with a new Fed governor in May, I think we are clearly on our way to 3% Fed fund rate by the end of next year.
And what importance exactly do the regional Fed governors have, Joe?
Well, they are part of the Fed Open Market Committee. So the voters for the interest rate cuts, they rotate. So there are 2 permanent members, which is Jerome Powell as the chair, and then the president of the New York Fed. And then the other ones, they're rotating through basically through the different regions together with the Fed governors. And those guys are setting interest rates. End of the story. All of these regional Fed governors are in office for something like 15 years at a time. They need to be reconfirmed every 5 years. And if they're not reconfirmed, there needs to be a replacement that needs to be found. But yeah, it's basically kind of like putting a lot of control over the voters for interest rates so that Trump gets what he wants, which is lower interest rates and, crucially, lower mortgage rates so people can afford their mortgages. And to be perfectly honest, that is where I'm really not seeing the signs. Because traditionally, what you do see is that obviously when the Fed hikes interest rates, long-term bond yields go up as well, not at the same pace, but they reflect the higher short-term interest rates. And similarly, when they cut. But this year, they have cut interest rates a couple of times already, yet 30-year Treasury yields continue to move higher and have continued to move higher yesterday.
Which AKA, we know as a steepening of the yield curve, don't we?
Yes.
But how steep can a yield curve go when the Fed loses independence? And when the president, who clearly is perhaps lacking in economic fundamental understanding, how steep can we go?
Theoretically, we can go very, very steep, and there is a little bit of an analysis that some guys from the Peterson Institute of International Economics have done, where they basically said, look, if the Fed loses independence, we assume that the inflation rate in the US will average 4%. And that would drive long-term Treasury yields up by another 120 basis points, so 1.2 percentage points higher. However, and that is the crucial bit. I think if the US government has full control over the Fed and the Fed becomes fully politicized, we will not even get to that point, because then the government can basically push the Fed to introduce QE or even worse, yield curve control, and basically say, we will buy anything that is longer maturity than 10 years if the yield is higher than, say, 4%. And then you all of a
I haven't
sudden
even got to this yet. I like
and
that,
then you all of a sudden get a massive rally in treasuries and in stock markets. Because basically the Federal Reserve would follow in the footsteps of the Bank of Japan. I don't think we're at that point yet, but it's an emerging risk for 2026.
And what on earth are the repercussions there?
Oh, the number one thing is a massive asset price inflation. So it gives you a real sugar rush on the stock market and in bond markets. But the long-term effects, and by the way, this is why I'm really bullish going into 2026 for US markets, because the government has all the levers to create another melt up in stock markets. But the price that we will have to pay in the US will be in 2027 and 28 with higher inflation and lower growth, so proper stagflation. Basically, if the Fed loses independence and we get to that point of QE and yield curve control, that is a point where basically the Fed follows the footsteps, not just of the Bank of Japan, but of the Turkish central bank. And that ended in 80% inflation. So that's going to be fun. But first, we get the good times before we get all the bad times.
And gold goes to 8,000. Bitcoin goes to 500,000.
Well, gold definitely rallies like crazy. Bitcoin, I never make a comment about Bitcoin because I have no clue. But gold would definitely rally big time. The other thing that you would see is that more investors, so it would be very weak dollar. And people moving into euro, Japanese yen, Swiss francs as well as a trade to get some safety.
Oh, suddenly I see 2027 as perhaps a time to be moving to New Zealand. And
yeah, but you know, 27 is so far away. I mean, there's so much water under the bridge until then that for now we should just enjoy the fact that I was wrong going into summer being bearish. Nothing has happened of the sort. And even though September is seasonally a bit of a weaker month, it's really hard to see where a major correction should come from now, if it hasn't happened yet.
Oh no, you've said it.
Yes,
famous
I know.
last
I jinxed
words.
it.
That's it.
I jinxed
NVIDIA. On NVIDIA Day, you're saying
on
it's really
NVIDIA
hard to.
Day, on NVIDIA Day, I jinxed it with NVIDIA trading at 30 times sales, so I think, you know, for now we kind of enter more of a bubble territory. But as a famous investor told me once, I don't have a problem as long as I'm in the bubble. I only have a problem once I'm out of the bubble.
Now, a very smart strategist has just talked about some rotation, value versus growth. What are your thoughts there?
Well, I mean, so the interesting thing, if you look at value versus growth stocks, it's been very different in Europe / UK and the US. In the US, value has continued to underperform. And this is what you read in every blog and every Substack, etc., that value hasn't worked, which is true in the US because, you know, there were all those tech stocks and the Magnificent Seven and all those guys, which are still technically in the growth basket and have performed very, very strongly. But basically, since 2022, in Europe and in the UK, value has outperformed growth, as it should have, because the value stocks tend to outperform when interest rates go higher, because banks tend to outperform in a higher interest rate environment. Energy tended to do well during the energy crisis 22-23. They are all in the value baskets, not in the growth basket. So UK and European stocks have done as they should. The Americans have not done as they should because of the Magnificent Seven, effectively. Now, the question is what's going to happen going forward. And while I think that in the immediate future, we're going to continue to see value outperform and growth in Europe and the other way around in the US, I think both will flip in 2026. So I do think that in 2026, in the US, value will start outperforming growth, while in the UK and in Europe, growth will start outperforming value. And now we can argue and discuss for a long time why.
I would love to do that, but first, what is in the growth basket in Europe? What kind of sectors or names?
Well, similar to the US, you tend to have tech stocks, you tend to have media stocks, but you also have quite a few retail stocks and consumer services. So these kinds of names and industrial services sometimes as well, but mostly consumer stocks and tech and media are in there. We don't really have that many biotech names in Europe, but they would also be in there in Europe and in the UK.
Got you. And anybody who is looking to play this, they're on the IG platform. I've just checked. There's MSCI USA Value ETF. There's quite a few there actually. There's, but yeah, that's the first one that jumps out. And then of course the iShares Edge MSCI Value Factor. So that's the way to play what we're talking about here.
And in Europe, you have the similar iShares ETFs.
Now let's do that then. Let's go into why you think that will be the case next year.
So in the US, I think the growth outperformance becomes a problem if the long end of the yield curve continues to rise. So if long-term treasury yields continue to rise and we don't get QE and yield curve control yet, that does two things. First of all, it creates higher discount rates for future cash flows, which means that future profits will be worth less today. But more importantly, it creates higher cost of capital for businesses. And at the moment, a lot of the Magnificent Seven, including one company that will report later today, is driven by the AI boom. And everybody and their dog are talking about how many hundreds of billions of dollars have been spent on AI. Well, a lot of that money hasn't been spent yet. It's all just promised. It's planned investments. But if the costs to fund those investments in the form of new debt or other ways of funding it increase, some of these investments will be canceled. And that means that you suddenly look into an environment where NVIDIA will not grow its revenues at, I don't know, 10, 20, 30, 50%. I mean, over the last 3 years, NVIDIA has grown its top line, its revenues, by 70% on average per year. Do you think that is going to repeat? I'm not sure.
I'm also just thinking down the chain a little bit, right? Because obviously we've got NVIDIA, and then the the four others of the Magnificent Seven are the ones who have been buying all those chips. However, the next step is obviously for them to monetize it. To monetize it, their clients have then got to use that. And as you say, if that's going to take big spend from the rest of the world's companies, and if the costs go up, then maybe that spend won't be as big or forthcoming.
Exactly. And then you add to that the MIT study that has been causing a little bit of waves last week, where 95% of generative AI projects, where basically CEOs have said that 95% of generative AI projects did not increase productivity and did not recover the costs. Obviously, we're only starting to figure out how to use that stuff. So I wouldn't take the 95% number too literally. But clearly, you need to justify these billions of spending, especially when your costs are funding those investments increase. And that's kind of where I think in the US growth stocks will slow down in 2026. Again, the big outside risk is the moment the Fed comes in with yield curve control and pushes the long end of the yield curve down. That is super for Magnificent Seven. So you could get a massive snapback if we get these kinds of external shocks, which just tells you that it's going to be interesting if nothing else.
But yeah, I'm feeling buying volatility could be a way to play 2026. A great question from Kieran McKenzie here, and perhaps this is when those of us in the industry forget that we have to join the dots, right? And the question is a great one. Why would you rotate from companies that have a future chance to outperform higher rates to those that almost certainly wouldn't? And that's because of valuation, isn't it? In a time of higher interest rates, what we're meant to do is contract the PE that these high growth stocks trade on, isn't it?
Correct, because if you have higher interest rates, future profits are worth less today because you're discounting them at a higher interest rate. And that means that your fair value for the same company with the same profits declines as interest rates rise. And the effect is stronger the more of your profits are further in the future, which basically means that growth stocks, which have most of their profits in the distant future, see more of a decline in their fair value than a value stock, which basically has more of its value today because they don't grow that much. They basically deliver your dividends and your cash flows today and in the next couple of years.
And of course, this was the story of the first 4 months of 2022, yes, when all the lights were flashing red, and we saw what happened.
Yeah, and it was also the story of 2023 when a lot of people were super bearish about stock markets going into the year, but because interest rates came down so much, it boosted stock markets and overcame the low earnings growth and made the market a bullish market.
Excellent. Right, I am being told to go to a break. However, one last question. What do you think of Trump Inc., the United States government, taking stakes in corporates as he's done with Intel? And now,
I mean, let's face it, that's not a free market anymore. This is the kind of stuff that you normally see in emerging markets, dare I say banana republics, where certain companies are coming under the influence of the government and are no longer trying to be as efficient as possible, but effectively are trying to curry favor with the political powers to be. And in the long run, that makes these businesses worse. In the short run, it's great news for companies like Intel because they just got a capital injection of $10 billion, which is great for a struggling company like them. But I would say on a 5-year or longer horizon, that is really, really bad news.
And even more interesting, Intel really needed that 9 billion plus the 2 from SoftBank. They really needed it. Defense companies do not need any saving. But the first thing I did yesterday when I saw Howard Lutnick talk about taking stakes in defense contractors was short every single one of them. Now, the logic behind that is Trump is not looking to take $20 billion and buy stakes in those companies. He's looking to say, look, if you want us to continue giving us contracts, you will give us equity. The guy is operating like the mafia.
Yeah, it's an extortion scheme.
It's extortion.
But,
exactly.
But we know how this plays out. We've seen it many, many times in countries from Nigeria to Brazil and Argentina. And that is the standard that the US is operating now, which always brings me back, since it's top of the hour, to something that a US hedge fund manager loved to say and tell me for the last 25 years. Capital always goes where it is treated best. And my response to that is, I agree.
Now, just expand, leave us with that golden nugget.
Investors will move their money to where the markets are free and where the capital can find the highest returns. And if the government is involved in businesses, that is no longer the case.
Just to finish on, for those of you that own BAE, British Aerospace, and Rolls-Royce, that is a significant negative, because what Trump is saying is US companies like Palantir, Raytheon, Lockheed, give us equity stakes and you will get our defense contracts. British Aerospace is not going to be getting increased defense spending on the back of that unless they also give a stake of equity as well. So I think this is highly negative for British Aerospace.
And I would disagree, simply because the real story about BAE and Rolls-Royce and the European defense contractors is getting the contracts from Europe and the UK. And that overpowers the issue with the US. So I think it's negative for Raytheon, General Dynamics, and those guys, but it is not a major factor for European defense contractors.
Fantastic. The viewers will be very happy to hear that, because they love their European defense stocks. So that has been absolutely fantastic. 25 minutes. I'm going to have to duck out and go straight into all sessions, but thank you very much, sir. Coming to you live from Panmure Liberum. Give Tom Price away for me there as well, please. And,
I will.
Great to see you. Thanks for joining us. Have a good week.
See you.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts.
Right then, no rest for the wicked. We are going straight into this all sessions open. What are we going to see here? So we've got, CrowdStrike looking to lead the pack. With Palantir up 70 basis points. Palantir, decent recovery yesterday, didn't it? Decent recovery, up 2.2% yesterday. As I say, I just think that is negative, that the government are going to go to Palantir and say, right, give us a 5% stake and we will continue to give you the contracts. We might even give you some more contracts if we've got a 5% stake. But Palantir, what does that do? Well, it's not all good, because they have to increase their share count by 5%. And you do not want to be diluted when you are already paying 110 times your sales, right? Dilution is really, really bad at those kind of levels. So that's why I'm still short Palantir, and sold even more calls yesterday at the 175 level. Salesforce up 40 basis points. We're seeing Delta strong, NVIDIA ahead of earnings, 182.5. Is that an all-time high? That would be going into numbers at all-time highs. We're going to be taking a look at what the expectations are shortly. Now, on the losers side, who's the loser of the day? It is, well, I see Wells Fargo up there. Not really many to go on there, is there? Alphabet, small down, traded $210 a few days ago. Now down to 206. What else we got? Not really any losers on the board there. I will go across to my my tier 2. Snowflake up 5%. Now, they've got numbers tonight as well, don't they, I think? So Snowflake up 5% ahead of numbers. That's a weird one. Novo Nordisk. Snowflake is on the back of... no, I wonder if there's an upgrade out there. Let's see what we can find. Novo's up 1% in the ADR. And yeah, that's about it, really. Baidu, the Chinese names are lower. Baidu, Neo, and JD all down nearly 2%, with MicroStrategy down 70 basis points at 349. Now, if we can go, let's see. Unfortunately, MongoDB is not a stock traded on the all sessions. But it has opened up at 282. So let's see what kind of mess I can get myself into with this option structure. So I put this on yesterday. What you're seeing there is the way that I structured it. So I just had to pay a very small premium. I think I ended up paying $1 for this structure. Now, what does that mean? Well, the P is for puts, the C is for calls. So I sold 2 of the August $165 puts, right? So I was prepared. The stock was at 215. If the stock was down 20%, then I would have been put upon, and I would have had to buy that stock on Friday. So this is Friday expiry, August the 29th. However, I took that premium and I used it to buy a 235 call. So that was to have the right to buy MongoDB at the price of $235, which was about up 8%. Now, so that's obviously fantastic because they're now trading at 280. But you'll see there, what was my mistake? Well, will it turn out to be a mistake? Because I sold 2 of the calls at the 275 level. So I sell my stock from 235 there, right? So I go long at 235, I sell at 275, but then I also go short at 275, right? So think of it like a pyramid. So I get all the profit from 235 to 275, and there I'm sitting at $4,000 profit. If this closes at $275 on Friday, I've spent $100 on it and I make 4,000. However, for every dollar it goes higher than 275, I start to lose that. I start to lose all that profit. And if it goes up as high as $315, then I go into loss and I start losing money at 315. So Julian Wheeler will have come on here yesterday, given me an absolute golden ticket, a lottery ticket, and I really hope that I don't end up losing money on it. So at the moment, it's at $281. That I will take. I'll be very happy anywhere between 265 and 290, right? This is on Friday expiry. I've promised to take the team out for drinks if that. It's an open bar on me, but it's got to be between 265 and 290. If we go much above 290, then I start to get a bit nervous on that one. So we're going to be watching MongoDB all day like a hawk. I'll be at the Coldplay concert at 9 p.m. refreshing my screen just as he's starting to come out with the belters. Of course, there's things I can do. I'll probably sell a put to try and get a little bit of long delta, right? So that's getting a little bit technical. Or I could take the whole thing off and I could probably take about $1,500 profit and not be greedy. But what do you do? What would you guys do? That is the final poll of today. What would you do in that position? If you've understood the way that I've described that, would you take $1,500 profit because a profit's a profit? Would you run it until Friday close and just close your eyes and not even look at it? Or would you try and be clever and start selling puts and maybe, you know, roll up the 275, roll up one of those calls to be short the 295s instead? You know, try and trade it and be clever. Try and do a Sosnoff and get myself you know, to try and get up to a profit of maybe 2,500 by giving some away. So what would you do? Would you take the profit immediately tonight before I go into cold play? Would you run the trade to the close on Friday? Or would you try and be smart and restructure it? Let me know in the poll what you would do, and I'll be very interested to hear. I'm not promising I'll follow your advice, but I will. I'll certainly pay attention to it, because I must admit I don't know what to do. It's not often you find yourself in a position when somebody like Julian Wheeler has come on and given you that lottery ticket. So good. Right, it is 9:10 people. We are on NVIDIA day. So how am I playing NVIDIA? Well, I struggle to see how NVIDIA is up more than 5% on these numbers. Now, how do I come out with that? Because of course, previously they've been up 15%, 20%. I mean, that was now 18 months ago, but we do know that they can have a big move on numbers. Why do I not think that happens today? Well, from the sheer law of large numbers. What do I mean by that? The stock is now a market cap of $4.4 trillion. If it goes up 5% today, that's an additional 220 billion of market cap. What kind of numbers does it have to produce to increase its market cap by 220 billion, right? Now, we know it trades on 30 times sales. So to increase in that kind of, 30 times sales, that means he has to beat by about 7 billion, right? By beating these numbers and taking up the guidance as well. He's never done that. He always goes 2 and 2. He beats by 2 billion and he increases guidance by 2 billion on top of that. So I cannot see how this goes up more than 5%. It wouldn't make sense. And that's where I'm happy to short calls. So I'm short the 195 calls on NVIDIA. However, I do appreciate that they might do well. So I am long some 185s. So I've got a 1/3 call ratio on. So I'm long 1. In fact, I'm long 2 of the 185 calls, and I'm short 6 of the 195 calls. So I'm in trouble if they go up to $202, but I'm prepared to be short at 202 because that just doesn't make sense to me on a market cap reaction. And I think that's what we saw in Microsoft. Microsoft did exactly that. Microsoft went up 9% on numbers and then gave it all back in the next few weeks. So I'm just looking what I'm going to vote in the poll. So get your poll votes in. And I've gone with that. So far, we got 64% of you are saying, take the profit and run, Rich. Enjoy your evening at Wembley Stadium and try not to get caught in the ring light. You all know what I mean by that. Yeah, it's a really, really tricky one to know what to do there. But before we go to this week's Art of Investing, then last chance to vote in those polls because we're going to have to take them on soon. And then we'll get to Art of Investing. So last votes go on. While those people are voting, please hit us with a thumbs up on the YouTube page. That would be gratefully appreciated. Like those videos, subscribe. And with 23 votes, let's close the poll and see what results we've got. 69% of you are saying take the profit and run, Rich, you idiot. That's $1,500 that you definitely didn't plan on. There was no skill involved. It was purely Julian Wheeler coming out with that cracking call yesterday. What an absolute treat. I did message Angeline and did tell her just to make sure she knew yesterday that Julian had come out with that. And we'll let you know. So 69% of you saying take profit and run. Then 13% of you saying go on, run it till Friday. 13% saying only time will tell. Only 4% of you think I should mess around and start selling puts and restructuring it. So yeah, you never go profit. You never go broke taking a profit. Very wise words from David. And Ben saying use it to take a friend to Coldplay. I'm actually going to Coldplay with 3 of my very good friends from university. So my housemate Duncan Mallins, a big shout out to Dunk. He was a 110-meter hurdler. I was a 400-meter hurdler at Loughborough University. And then, so Duncan and I lived together in the student digs, but my girlfriend at the time had a best friend, and the best friend came round to watch a movie one night. I'm trying to remember what it was. It was that Blair Witch. Came round to watch Blair Witch. That giving my age away. So anyway, Duncan and Freya came round, and it was instant love. They looked at each other, and that was it. By the end of the movie, they were sitting next to each other on the sofa, kind of giggling and everything. And they are now married with 3 beautiful, wonderful children from that moment on. So I'm going, it's Duncan and Freya, and then my very good friend, Rosalind Brett. Rosalind was a swimmer in the Sydney Olympics, and then also Manchester Commonwealth Games. So Ros was an incredible butterfly swimmer, and the 4 of us are going to see Coldplay tonight. So I cannot wait for that. Very wise words from you guys. Take the profit and enjoy the concert. I hope that you are all about to enjoy Art of Investing. That's coming up next. I'll see you tomorrow. Big thumbs up as we go. Thank you, producer Phil. Thank you, Dom. Thank you, Cam, for today, and Luke Moore for joining us as well. Good luck. Wish me luck in Mongo TV.
It's a cheap market, but it can stay cheap for a long time.
Spice, our patriot of the FTSE 100.
The idea is that these cheap stocks at some point increase in price and go back to a higher valuation.
Forget Tom Cruise. You don't want to be a maverick when it comes to investing. You want to be Iceman. Slow, calculated, no mistakes.
As chairman of the board, that seems fine.
Drum roll, please. Chairman, what was the overall performance of the first week of the model portfolio from Art of Investing? Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 6 of The Art of Investing, brought to you by IG, the global investing platform. My name's Rich McDonald, and as always, I'm joined by CJ and Spice. And today we're going to be talking about the UK. Spice is going to be taking us through why the FTSE 100 has been so disappointing as an investment relative to others. And with 12 new all-time highs this year alone, is there some signs of hope for the future? And we're also going to be looking today at a question from one of you, Matt Carter, sending us in an email saying, really enjoying the podcast, but I've got some cash on the sidelines I've been looking to invest. How exactly should I go about it? So we're going to be going through how you open an account and what the features are on the IG platform. However, without further ado, we go across to find out what the movers and shakers of this week have been in today's Spice Market Update.
As Rich said, we're hitting lots of new all-time highs. The global equities have hit all-time highs, the S&P 500, NASDAQ, and the Nikkei in Japan. Also, Bitcoin, interestingly, managed to make a new high. And now the crypto market's been doing pretty well underneath, is now back to being valued at about $4 trillion, which, if you remember, is the size of NVIDIA, give or take.
One stock.
One stock against the whole of the crypto market. The key for these new time highs is being driven by the fact that the earnings from the companies, as you know, we've been reporting the second quarter, have come through much stronger than expected. And so to the point that now earnings are about 10% higher than the forecasts were at the beginning of the year.
Wow.
And that's quite punchy. So it is all about, as we talked before, expectation management. The US particularly have done an excellent job making people think things are very tough and difficult, and then coming in and smashing the numbers. And, you know, a lot of that has been driven by the Magnificent Seven, as we know.
And of course, that wasn't quite what people were expecting back in April when Trump announced the tariffs. And this week we've seen Donald Trump have a real go at Goldman Sachs because they dared to question that the US economy might suffer.
He doesn't like people who don't give the right message.
Well, if you pay him enough, he'll like you. We know that.
Yeah.
As Apple have found out by offering another $100 billion and seeing their shares go up 8% in terms of investment. So it's pretty punchy out there. But last night, talking of the world's current biggest company, NVIDIA, back in March 2000, the biggest company in the world was Cisco Systems. And Cisco was the provider of all the internet backbone, if you like, for the world. And as we know, the dot-com bubble was brewing and going nicely. Cisco had the results last night. They actually beat expectations, but not great expectation management. The shares fell again a couple of percent. And now we're starting to look at data. So when investors don't have the ability to get updates from companies all the time, they start to look at the economic data comes through. So you'll hear us in the next few weeks perhaps focus a bit more on that than we have done in the last few, because we're moving away from corporate earnings into economics, as it were, and those underlying drivers. So interesting on that front. When we sat down last week, the Bank of England had cut by 0.25%, which is great. They had to vote twice on it, though. It wasn't clear cut. 4 of the members voted for a 0.25% cut. 1 member voted for a 0.5% cut and 4 others voted for no cut.
How often does that happen, a second vote?
Well, that hasn't happened, I think, since 1993, I think was the last time. So it's pretty unprecedented. But the chairman asked them to re-vote, and they came back and they got 5-4 in favour of a 0.25% cut, which we've seen. Now, the interesting thing is that, the interest rate cut came through despite actually we had some pretty poor inflation data in the UK. It wasn't great. It was a bit higher than expected. And now inflation is expected to rise steadily over the next few months, up to about 3.75%. The core is over 4%. That is going to weigh on their ability to cut further from here. And we'll talk a little bit about when the next rate cuts are expected, and we'll do that for the UK and the US. On the other side, we've had good GDP numbers in the UK this morning, where actually GDP grew by 0.3%, which was a bit better than expected.
And just remind us all exactly what GDP is.
Gross domestic product. It's the way you measure the growth of an economy.
It's the output of the economy over a particular period, and people tend to use GDP as the measure. So when we see numbers going and increasing, then that's really good news.
Okay, and a recession is when it goes negative.
Another bit of poor data, which actually enabled the Bank of England to feel pleased that they were cutting interest rates, was that the unemployment data was a bit worse than expected. So unemployment now in the UK is at about 4.7%. Now, compared to history, that's very low. So Chris and I remember sort of sitting on a train with a carriage of 20 people back in the early 90s. And by the end of the recession, there was basically about 3 of us left. Everyone else has lost their jobs.
I love steam trains.
So yes, we've electrified since then. But back then, unemployment rose to nearly 12%. And we're down at 4.7 now. So that's still pretty good. In the US, we've had some good economic data this week, particularly on the inflation front. If you remember, Chris talked about it in his bond episode, etc. But when inflation is coming down, that gives central banks, the people who set interest rates, the ability to cut interest rates if they want to. And that's basically what the market has jumped on top of this week. And they've basically said, okay, now we expect the Federal Reserve, which is the biggest and most important central bank in the world, to begin cutting interest rates again on the 17th of September, which is when they have their next meeting. Then it's now a 99% probability that they will cut, probably most likely by 0.25%, a quarter of a percent. But some people now even say it might be 0.5%.
Right.
Because this inflation was a bit better than they expected. But the market are already going, well, when's the next one after that? So the next one they expect now to be in November, when they have a meeting at the beginning of November, and then another one in December. So the US is now looking for 3 interest rates, maybe 4, so 3/4 to maybe 1% of interest rates between now and Christmas. That would be a nice Christmas present for people who have big credit card debts and debts in the US and mortgages, etc. And the markets have jumped on this. They love interest rates being cut. And sure enough, that's what's driven and helped lift the markets like the S&P 500 particularly, and NASDAQ up to all-time highs.
Now, of course, that's the data. But next week, we hear from Jerome Powell at a special symposium, which is outside the normal Federal Reserve meetings, isn't it?
Yes, it's called Jackson Hole Symposium. It happens once a year, and it's normally sort of some big theoretical subject, but it's always a chance for the chairman of the Federal Reserve particularly to stand there and say what he thinks about, his views about the economy and what that might do to interest rates or not. Very quickly, the UK is, as I say, has had this 1 rate cut. The next interest rate cut, those of you who are out there interested, maybe thinking about your mortgages, etc., the next expected cut is meant to be probably there's an 88% probability of another cut on the 6th of November, which is their next meeting. And if it doesn't come then, there's one just before Christmas on the 19th of December. So hopefully the UK will get another rate cut then, which will be great.
Excellent. So, of course, last week we initiated the model portfolio. CJ, give us the update. How's it gone so far?
There's a couple of things I want to get to before we actually look at the numbers. And I think these are important things for us to remember, given the groundwork we've laid over the last few weeks. The first thing to remember is that this is a long-term portfolio. And so whilst reviewing the performance every week is important, it's fun, you can take the mickey out of me, you can do what you like, we've got to give positions time to work. These are long-term positions, and so you shouldn't expect a change every week. We will be changing things, but we've got to give things time to play out as we think they're going to play out. Now, clearly, if we change our mind, if we've changed our fundamental thesis, then we might change those positions. But while we haven't changed them, then we're not going to see much change. The second thing, and I think it's something that Mark and I feel very strongly about, is that people need to understand that the enemy of position taking, the enemy of running your portfolio is emotion. The best decisions are taken when people are calm, they're thinking about things, they're not reacting to events. And if they're doing it at those times, they're going to make sensible decisions. Now, the reason I say that is because all professional investors can think of many times where they haven't done that and things have gone wrong. And of course, then psychology takes over. I've got it wrong. How much money am I going to lose? Oh my God, I can't look at anything else. All I can look at is these prices going down all the time. What am I going to do? Next day, same thing. And in the end, the heart rate's going up and we think, I can't think of anything else. This is dominating everything. And in the end, when you're getting psychologically involved in positions, you do stupid things. You're going to see our portfolio. Events are going to happen to us over the next year, 2 years, whatever it is. At various times, we're going to see big falls, big rises, various things. And what I'm hoping is that by you, the listener out there, seeing how we react to these events, it might help you in your financial journey and these investments that you're holding to make better decisions.
The way I like to think about it, going back to a movie reference like Top Gun, forget Tom Cruise. You don't want to be a maverick when it comes to investing. You want to be Iceman. Slow, calculated, no mistakes. Val Kilmer beats Tom Cruise every time in the investing world.
I think it's a very, very good analogy, and that's exactly what we've got to be, Iceman. Before we get to the portfolio, I just want to mention a little bit on ETFs. If we invest in individual shares, we get a lot of company risk. So if we buy BP, we hold the BP shares. If BP do well, that's great. But if they do badly, they do badly. But the whole index level, the whole of UK market, for example, it's not just BP, it's a whole host of other companies. If we buy an ETF in the UK, a FTSE 100 ETF, we have a bit of every company, and therefore our portfolio will move like the market as a whole, not as one individual company.
And so what does ETF stand for?
Exchange Traded Fund. The advantage of them are they're very cheap to deal in because they're listed on the stock market, so you can buy them. You can buy and sell them at any time, but they give you the return of the market.
The way I like to think about ETFs is we're all going out for lunch afterwards, right? Now, there might be an a la carte menu, or there might be a menu of small plate dishes. Now, if you just choose one a la carte meal, there's every risk you choose that dish and you're paying £25 for it, and it comes and it either doesn't taste right, it's not what you wanted, not what you expected. If you instead get 6 small plates for the same amount of total costs, you've got diversification. And if there is a big mistake in a single stock investment, such as the BP disaster that we saw in the Gulf of America, then that's a shock, right? And your single stock position suffers. But if you have an ETF, then it's much more diversified, isn't it?
Yeah. And so they've got huge advantages. They give you that diversification of the whole index, but they're very cheap to deal in as well and very easy to deal in. That's all I wanted to say. So let's get on to the portfolio. So rather than me go through the portfolio, I thought Rich, who did a wonderful job last week as the minute taker of the committee, he can go through how things have gone.
Well, thank you, Mr. Chairman, sir. Japan was our best performer on the week, giving us a contribution to the portfolio of 0.18%. Now, what does that mean? Well, that is the total return. Remember, we've only got 10% of the portfolio in the Nikkei 225. So what you do is you take that 10%, we got a 1/10 weighting in the portfolio. So the total return of 0.18% actually means the index went up by 1.8%. You multiply it by 10. Similarly, the NASDAQ 100 was up 1.5% in the week. So that's given us a 0.15% contribution. But then look at the crypto and blockchain innovators ETF. Now that gave us a performance of 0.12%, but we've only got a 5% weighting. So you actually multiply it by 20 and you find out that that was our real best performer of our positions, going up 2.4% in the week. Now, if we look at what lost us a little bit of money, it is gold. Gold, we've got a 10% weighting, and that was down 1.8% on the week, which takes 0.18% off our total. So, drum roll, please. Chairman, what was the overall performance of the first week of the model portfolio from Art of Investing?
Well, we have a return of plus 0.53%. Now, as I said, don't take too much notice of it because we've only just started. It's long-term investment, but it's better to be up than down.
But you're not retiring?
I'm not retiring yet, although clearly, if one annualized that performance, we would easily get to our target levels.
Right in the middle of the pack there, you'll see the FTSE 100 was up 0.8% on the week, giving us a contribution of 0.08%. And that is our specialist subject of the day, Spice, our patriot of the FTSE 100. Take us through the history of this UK index.
So I'm gonna look at the UK overall, but we'll ultimately end up focusing on the FTSE 100 because at the end of the day, it is the majority of the equity markets in the UK. There are 5 actual indices in the UK that you can invest in. And you can do that through IG, you can do it through other platforms, etc. But the biggest one is the FTSE 100. And the clue is in the name. It has the top 100 companies in the UK by market capitalization. Now, market capitalization is the share price multiplied by the number of shares in issue, and you get a big number. So if you did that for all the shares in the FTSE 100, the total market capitalization, as it's called, is about £4.8 trillion. So there's a lot of noughts in there. And it's a very big blue chip multinational company index. And about 80% of the revenues in those companies come from outside of the UK. And hence one of the reasons buying the FTSE 100 rather than buying something like China directly or Hong Kong is called the China chickens trade, because the FTSE 100 has about 20 to 25% of its exposure in Asia.
Why is it called the FTSE? What is this FTSE term?
So it's the Financial Times Stock Exchange 100 share index. It was established in January 1984. Seems like it's been around a lot longer. It's about the same time Chris and I have been in the market. So, well, Chris has been there since the beginning. I only came in the late 80s, but there we go. Over the long term, the returns since the FTSE began has basically returned between 7 and 8% annualized each year.
Oh, that's all
So
right.
that's pretty good.
Seems pretty decent to me.
Yeah.
As chairman of the board, that seems fine.
Of that, about half of it comes from the dividend within the FTSE 100, because the dividend of the FTSE 100 is renowned the world over for being one of the highest available dividend yields. So like getting your interest on a loan. But the FTSE 100 pays about 3.5% in terms of dividend. That's very good. And it's the biggest in the world of the major indices that are out there.
Bigger than the US.
Certainly, it's about double what the US pay.
Wow.
But that's if you're after income. And that, I would argue, is one of the failings of the UK. But there we go. We'll come on to that later. The mid 250 has delivered a little bit more than the FTSE 100, actually. It's delivered between 8.5% and 9% over the same sort of period. And the small cap has actually done the same as the mid cap, give or take. In fact, in some years, it's done better because from time to time, they have big bursts of performance. So the UK as a whole has done 7 to 8% over the years, but that compares with the S&P 500 of about 10.5%. NASDAQ, which we know is their tech and growth index, is about 14%, and then the US small caps have done about 7 to 8%. So the UK is sort of doing what the US small caps have done over the years, a bit less than their S&P 500 and the NASDAQ. Driving a lot of stock markets is something that we need to probably explain a little bit. They're called factors. They're the distinguishing features, if you like, of not just a stock maybe, but a sector or a stock market as a whole. So there are many different factors. The most common ones are things like quality, cyclicality, value, growth, and defensive features. So value, for example, the ones that are most prevalent in the UK are a value factor. This is where companies look cheap. They seem very cheap compared to what everyone believes is their true worth. That's based on things like earnings or assets. And the idea is that these cheap stocks have a very good chance to, at some point, increase in price and go back to a higher valuation. But you often need a catalyst to do that. Now, the UK has got many of these value companies in it, and we'll talk about that more in a minute. There's a growth factor. So companies that grow above the average and above the global GDP rate. So companies that can grow their sales, their profits better than the average. And investors buy these because they hope that the value of the shares will go up more. They're not really interested in getting dividends, but they're interested in the growth side of it. And then you have companies that are income on the other side, people who just want to have dividends or a high income. Like the FTSE 100, as I said, yields about 3.5%. So it gives you a 3.5% dividend effectively. And that is basically more driven by sometimes what's happening in the bond markets. And the valuations drive that. Again, the FTSE has a big amount of exposure to income.
Can companies choose which factors they have in it? For example, if CJ and I had companies, then obviously CJ is a value trade. I would be a growth factor. Can we say that's what we are, or somebody else chooses?
There are indices that do actually distinguish between the two, and they make a judgment, not for you to decide, but it's a bit like Donald Trump deciding someone, but they do it in a much more rigorous and fundamental way. And they will be looking at the revenue growth, for example, and the revenue growth has to be above average to potentially be a growth stock. If it's below average, then it may be a defensive or it may be a values company. But you can't just say, I'm going to be a growth company.
I mean, in the simplistic version, you might say, are the profits going up by X percent each year? And if they go up by 15% a year, let's say, or 20% a year, they might be called a growth company. Whereas if they go up by 2% a year, they're probably not going to be a growth company, but maybe they pay bigger dividends. And so they might be called a value company.
So the main factors affecting the UK are value, growth, income, and defensive sectors. Now, defensive factors. And those are companies like British American Tobacco, Associated British Foods, who own Primark, Unilever, utilities and telecoms companies. They have very steady growth that isn't really affected by the underlying economy. They're just steady growers. They tend to generate quite a lot of cash, and they can quite often become both defensive and income companies because they generate lots of cash with not very much growth, and they give the cash back to shareholders in the form of dividends. So it tends to be higher income stocks in that sort of area.
So we said there's no tech companies really in the UK. What do we have then? What's the index dominated by?
So the index, the top 5 sectors are financials, which is banks, insurance companies, etc. Consumer staples, which is, companies like sort of Unilever, as we talked about now, British American Tobacco, etc. Now, financials account for 23% or so of the entire FTSE 100. Consumer staples are about 18%. Below that are industrials. Now, industrials, you might think are a bit more cyclical, but actually in the UK, about half of that industrial sector is British Aerospace, or BAE Systems, and Rolls-Royce. And now they are long order books, steady business year in, year out, and they don't go up very much. So they're actually probably a bit more defensive and value orientated than perhaps some of the others. Then the other big sector is healthcare, which we know has got the companies like AstraZeneca and Glaxo in it, and energy. So that's obviously sort of BP and Shell. And energy is 11%, healthcare is about 11% too. But those 5 sectors there, I would say that financials are considered value.
Okay.
Consumer staples, defensive. And industrials, value. Healthcare, defensive. Energy, value.
Right.
So I've not once said the word growth in there, have I?
No.
And the trouble is, I will then go through the top 5 sectors in the US very quickly. Information technology, that's growth. That's 31% of the S&P 500.
And that is tech, really, isn't it?
Exactly. Financials are about 14%. Well, their financials are slightly different. They're quite exposed to stock markets because they have big investment banks like JP Morgan, Goldman Sachs fall into that category.
So the FTSE, you're talking about Lloyd's and you're talking about NatWest, whereas in the US, you're talking more Goldman's and Bank of America.
Yes. So they're more linked to how the stock market does, potentially.
Okay.
And then there's consumer discretionary, which, by the way, in America includes things like Tesla and Facebook. So that's about 11% of the market, and then communication services and healthcare. But, those are much more growthy sort of areas than the FTSE, as you can see. And yet those top 5 sectors both account for about 3/4 of the entire index. So just the top 5 sectors.
Well, it's obvious then you surely invest in the S&P 500. Why do you bother with the FTSE at all?
Well, I ask myself the same question every week. So the FTSE 100 has about half of it is what I would call value. And the S&P 500 is only 25%, so about a quarter of it. Income in the FTSE is very important. About 40% of the companies there are what you might call income stocks. In the S&P 500, it's just 15%. There's only about 15% of the entire FTSE 100 that I might call growth. In the S&P 500, about half the entire index is what you call growth. And then this quality defensive side, about 35% in the FTSE and about 25% in the S&P.
Now, it's been noticeable over the last year and a half, as those yield curves have gone from this funny inverted shape to a positive, banks in the UK have been fantastic.
Really great investments.
Right? And FTSE has done better this year. Now, don't get me wrong, FTSE's done terribly against something like the S&P over 10 years. I mean, it's done all right as an absolute performance, but as a relative performance, it's underperformed the S&P 500 in the US massively.
Yeah.
But this year, it's getting some of that back. So firstly, I would say financials are being re-rated. Anywhere I go and I talk to people about the financials being re-rated, this is with very important bankers of the past and people who are dignitaries of today, they always say, oh, rubbish, banks are useless. And they've been short of them forever because of what's been going on. And now they're starting to lose money. So when I say short, they haven't owned them in their portfolio. And now they're going up a lot. And they're now saying, oh, maybe I should buy some of these. So firstly, the banks.
Yeah, but Barclays is up 150%, NatWest up 100%, even Lloyd's is up 75%.
Correct.
There is another big driver to these banks, which is important, which is debts, bad debts. If the economy is going into recession, banks are at the front end of that. People don't pay their mortgage, they don't pay their credit card, they don't pay their loan off. And that the bank has to write off that loan, if you like. So during bad economic times, banks are pretty poor investments because they're having all these bad debts that they're having to absorb year in, year out. Now, when they're cutting interest rates, like they're doing at the moment, we've seen that in the UK for the last few months, that means that the pressure on someone paying their loan or their credit card or their mortgage is easing. So the number of bad debts they get reduces. And that is one of the reasons bank profits go up, because they're not having to put as many bad debts through. And that's a very positive thing. Now, if the economy starts really going nicely and interest rates stay low and the yield curve, as Chris says, stays in the shape that we're talking about, that's a great environment for banks.
My second point for the defence is that the UK has been an underperforming market for a long time. Everybody knows, and it's very cheap in that sense because it's full of value stocks, as Mark has said so very clearly with terms of this factor analysis.
When you say cheap, you just mean that the number that you buy the FTSE at is low? What does cheap mean?
Relative to other markets, when we look at its price-earnings ratio, when we look at the number of comparative statistics, it's cheaper. The numbers are lower in the UK than they are in other markets. Now, my belief, and I accept this is my belief, and it is not shared by most people, is that they will not, they know growth is important. They will not slap on a huge amount of taxes. And so all the bad news that's being discounted by the market, taxes are going to have to go up, it's going to be terrible. There'll be relief, go back to expectations, as Mark has talked about before. The expectation is that taxes are going to go up a lot. If they don't go up a lot, that may be time to push the UK market upwards. Because if they do put taxes up, it's a cheap market, but it can stay cheap for a long time.
The interesting thing is the small cap in the US, the Russell 2000 index, as it's called, is up about 6% this week. And it's going up. These interest rate expectations, that the interest rate cuts are now beginning to be built in, and the confidence in those cuts coming through has been built in. At the same time, Trump is bringing a lot of manufacturing back into the US. That's going to help the small and mid-sized companies in the US hugely. And that index is beginning to move. Now, we have to watch that very carefully, but it is coming off a low base because the Russell 2000 has been a pretty poor performer for the last couple of years. So if this gains credibility, then again, we might be able to put some money into the Russell 2000 if we really believe that interest rates are going to come down more than people expect. And that domestic economy in the US, driven by Trump's getting manufacturing back to the US, making America great again, will actually help that index more than perhaps some of the others.
Mark's highlighted that the UK has its attractions, but they're not attractive in the global scheme of things at the moment. There's cheapness there, but is there the catalyst to bring that cheapness out?
If I can take that one stage further, we've got two coffee shops next to each other, right? And one is very fancy. You get the macchiatos and the, all the...
Sorry, what are they?
The marshmallows or whatever, But that costs currently £12 to buy that coffee. The highest that traditionally it's been. And that's the US market at this moment. And then you've got a nice little cafe next door, does a great coffee, and that's only £4. So some people are very happy to go and buy the fancy stuff. The growth factors that you've proved are much more interesting. But at some points, it is the right time to just go to the nice little cafe.
When the economies are tough and there's recessions, the UK tends to do better. Right? And it goes back to your coffee shop analogy. You're not going to spend £12.50 on a macchiato with a marshmallow on top of it, with a funny leaf on the top. You are going to, you'll trade down, as it's called. You'll go from the £12.50 coffee to the £4 one. And that's what happens during recessions. People trade down. They don't spend as much money on food or expensive clothes or going out. They come down. Now, that's when the FTSE 100, as a defensive, high-income, high dividend-paying index does well. So since the FTSE 100 was established back in January 1984, there's only been 4 distinct years where the FTSE 100 has outperformed the S&P 500. One was in 2008 when we had the global financial crisis.
Right.
And that's because we had much higher exposure to defensive sectors like Unilever, big dividends paying companies, rather than the US, which is heavy in tech. All the banks did badly, including the UK ones. Most of them went to zero, a lot of them. 2016, when Brexit happened, the Brexit broke happened, sterling, if you remember, fell 20%. When 80% of your earnings come from outside of the UK, they're benefiting because the dollar effectively went up 20%. So the earnings per share of those companies went up. And even though the stock market went down, the overall thing was... So actually, the FTSE did, 13, 14% that year, and the S&P only did 12%. So it marginally outperformed. And then the last time was Russia-Ukraine, where basically we had massive inflation because Russia invaded Ukraine. The oil price nearly doubled. Commodity prices went through the roof. And the FTSE 100 is full of mining companies and full of energy companies.
And Rolls-Royce and British...
aerospace,
and
defence
BAE,
companies.
Yeah.
Defence companies, absolutely.
Okay.
In conclusion, then, we've got a market that we all understand is cheap and has got some factors which are attractive. But it's all about that catalyst. What's going to make those factors come out? We've solved that a bit in our portfolio by having 10% in the FTSE because we recognise it's got some attractions, but it's quite low weighted. We need to see when the budget comes out whether there's some encouragement. If there is, then maybe there'll be a fight for maybe where we put some of that extra money that we saved at last week's meeting. Remember, we put 20% in short gilts to wait and see what happens. But it's too early to do that now. So no change to the portfolio is ensued.
Wonderful. Right. One of the questions that we got from a viewer. Well, first of all, he really enjoys the podcast. He thinks that the two older gentlemen really know what they're talking about. Not sure what he means there. And, but he does have some money sitting on the sidelines that he wants to invest. He just didn't know how to start. So how do you open an account and what do you do from there? Well, the first thing to do is to go into the show notes below where you're listening to this podcast or watching on YouTube. And there you'll find a link to help you open an account. You go through the account opening process. And then, of course, you fund the account. You send your money through. And you can choose whether you would like a stocks and shares account or an ISA, which is an individual savings account where you don't pay any tax on the gains or the dividends. Or you may want to manage your pension yourself in a self-invested pension plan. That's a SIP. Those options are all available to you on the website. As I say, just click on the show notes below. But of course, other platforms are available as well. You have a Google, you can have a look around. But then there is an Art of Investing watch list. The watch list will detail all of the ETFs that we have included in our model portfolio. But there's also other watch lists, popular stocks, popular markets, other ETFs that you may be interested in, all depending on your age, on your risk appetite, and of course, your own feeling of how markets are going. Maybe a little bit more gold, a bit more copper. It's all down to you. That is the art of investing, putting not just the expertise that you hear on shows such as this, but also your own feelings about the world. Gents, that was the question from Matt Carter. But what if more of our viewers have questions? Where should they write to?
The Art of Investing at IG.com.
Fantastic. Almost as good as your chairmanship this week. Right. Thank you very much for joining us on this episode 6 of The Art of Investing. Boy, time goes quick, doesn't it? Tune in next week to find out how the portfolio has performed. Are we going to get a pullback? Or is Spice's bull market going to continue, especially in the US? Please give us a like, a subscribe, and a follow. And send us your emails, comments, or if you think we're barking up the wrong tree, you don't like the model portfolio, what amendments would you make? We're very keen to hear them. Gents, we'll see you both next week.
Thanks. Looking forward to it.